Hey, welcome to the Hivemind podcast. I'm your host, Daniel Martinez. Today I have special guest Craig McGrouther, and I did not check his name if I was going to say it correctly or not. Did I say it wrong?
That was pretty good, honestly. Everyone says it wrong, so it's all good. It's McGrouther, but that was such a good first rip guess that I'm very impressed. So we'll rock with that.
Yeah. Most time if I don't know, I just say this first name, so it's Craig. Yeah.
Yes, exactly.
What part of the country are you from?
Yeah, so I actually live in Phoenix, Arizona. I'm actually today in Houston,
Okay.
Texas, looking at our deals. We've got about $400 million in our portfolio out here in Houston. So I'm out here right now looking at some of our assets, and we're making a very big push to meet as many people as we can in person, investors, capital partners, you name it. We're looking to do it. So we're meeting with a lot of our investors and said partners out here today at one of our properties tonight in a few hours. So.
Okay. So when you say $400 million, everyone's gonna be like, "I'm gonna end the episode." Like he's so crazy. Like that sounds crazy numbers. How do you deal with crazy math when it comes like that? Because anything over like 10 million, everybody just like zones out.
Yeah, I mean, it's one of those things where it's just going to take time. And I think people overestimate what they can do in 1 year, but underestimate what they can do in 5 years or 10 years, right?
Ooh.
So we've been going at this for, 6 years now. This is really just a culmination and accumulation process of stacking property after property after property after property, growing slowly. And then at a certain point, you can kind of get critical mass and everything can kind of scale accordingly. So we've been able to do that just deal to deal at a time. And hopefully, we have all these deals right now. And in 5 years or 4 years, when the market turns, we'll be unleashing it and selling them all off and kind of trading through the portfolio and going from deal to deal to deal. But it just takes time and it's building the right teams and systems and growing slow and putting a point of an emphasis, relationships, growing those and making sure that we take care of everyone and take it a day at a time.
All right, so let's jump into a few things. Let's talk about like business model. Are you guys like buying and holding till the market turns? Kind of what it sounds like. Are you buying, holding, financing, refinancing? Like, what's the process look like?
Yeah, great question. So we're a little bit all over the board in a good sense, not from a direction sense, but we've
Yeah.
got some deals that we're accumulating right now, buying more. We actually refinanced 6 properties at the time last year where we had about 14 properties in our portfolio into longer term tax payment structures, which is unique and allowed us to, really stabilize some of these deals that were on different and less than optimal financing terms. They were short term notes, whether it be bridge or floating rate deals that had some maturities coming up. So we unfortunately were able to transition the property last year into longer term deals. We're looking to accumulate deals. Typically speaking, we like to hold deals somewhere between, projecting right now 5 years, but somewhere between, call it 4 to 6 years would be the sweet spot for acquiring and holding properties. And we're looking to do on the financing side, agency fixed rate debt is the name of the game currently.
So, what does long range commercial debt look like? Because I know the bridge debt's usually like 24 to 48, like 12 to 24 months, because it's a bridge loan. You have to refinance and buy down points and all this stuff. What does like traditional like long term financing look like for commercial?
Yeah, so, as you just mentioned, unlike residential real estate, which is kind of where most investors start, where most people come from is the single family world, whether it be your primary house where you put a 30-year mortgage on it, typically speaking, you're doing an FHA, a VA loan, something of that nature, you're looking at a 30-year note, typically speaking.
Yeah.
Commercial world's slightly different, right? As you know, as I'm sure a lot of your audience knows, just the way it works, typically speaking, you're not getting debt terms that are longer than 10 years, which creates a lot more financing and maturity options that kind of come up, which kind of creates stress or unique opportunities for buyers to come into place and for financing just to always be occurring. So long term on the long end of things is probably a 10-year financing and debt rate. On the short end, it would be a bridge deal that might be somewhere between 24 months. What we like to do is actually just right in that middle sweet spot, which is a 5-year debt term right now, based off the 5-year treasury plus a lender spread in there. And what we're looking to solve for and do is fixed rate debt.
Do they do like do they do 30-year AMs with like a 10-year balloon, or is it like what's the? I've
Yeah,
never done commercial. I'm like genuinely curious.
yeah, absolutely. So the way it typically works, there's not much of a balloon payment system in these deals. How it typically works is you've got a maturity note, and there's just typically speaking an exit prepayment penalty if
Okay.
someone wanted to leave out of the deal. So in the commercial space, it's called yield maintenance, where you've got yield maintenance where, for the deals that we're doing right now, we're doing, as I said, 5-year debt terms. And that 4.5 year point, that 4.5 year mark, is where we could sell the deal at no penalty to us. Now, if we sell it before that, there is a balloon payment, whether it be a percentage point based upon the property value or the loan note, something of that nature. You have to, cough it up because these are not the cheapest deals as you can imagine on the debt side. But if it makes sense and if it's beneficial for all parties, we will kind of eat that bullet, if you will, and kind of exit the property at that point.
It's a with 10-year with 10-year AMs and 10-year loans, the cash flow it absorbs your cash flow.
Yeah, so sorry, I made a little mistake there. So typically speaking, the amortization point is 30 or 35 years. So just like that, like a residential deal, 30-year amortization,
Okay.
but you do 10-year debt notes, which is a little bit counterintuitive. So you can
Yeah.
pay it down over time, but typically speaking, people like to lever up commercial real estate as much as possible
Yeah.
and maximize their LTV or LTC on these deals to juice up their returns. Obviously for a equity multiple purpose, as opposed to a lot of the residential world or other kind of real estate profiles are longer term. But make no mistake, the best financing terms in the world are single family residential sub 4 unit deals for that exact nature. You can lock in incredible debt. I mean, how much of this country right now has interest rates and debt terms that are sub 4% or are
Yeah.
fully free and clear? This is why, in my opinion, there's not going to be any sort of housing crisis or crunch there because this debt is so sweet. Now, on the other end, the commercial real estate world is definitely going to experience some turbulence and some issues because of these maturities. A lot of people bought deals on bridge debt or floating rate debt terms, and they've got maturities coming up where they're going in cap rate is, and the value of the property is now less than what they bought it for, creating a very unfortunate situation where either a couple things can happen. They can, put in equity into the deal to essentially, balance that out and pay off where the lender's at so they don't owe money. They can get foreclosed on, or they can try to extend the property and do a year or two extra on that note to kind of live for a better capital market. So any way you slice it, the shorter the debt term is, the riskier the deal is. This is why when I look at residential real estate specifically for my own use or just for investment purposes, you really can't beat the note and the amortization because we both know, typically speaking over a 10-year process, assuming a normal market condition, you're probably almost going to double the property value almost, right? Or get darn near close to it.
Mhm.
Where, if you put basically sub 10% down, well, the equity, lift there you're going to get for the cash you put down is going to be super attractive. Imagine you, for instance, buy a place for 500K, you put 50 grand down, and 10 years from now the place is worth 800,000. Well, your 50K just made you $300,000 of appreciation over that term. So can't really beat that.
How are you guys? And I've seen a lot of like capital calls lately, and I've seen a lot of like equity being destroyed through cap rate
Yeah,
at cap rates going up,
expansion. Yeah.
which decreases the value of the asset. How are you guys like fighting that? Because and it might be it might be your market or your underwriting or your buying power. I don't know. I've seen a lot of capital calls lately, and I've seen a lot of like expansion of cap rates, which is absorbing all these LPs equity into non-existence.
Yeah. Well, to that point, where people have really, are taking some pain and medicine right now is due to the nature of the debt.
Yeah,
So the deal is only as risky as the debt profile on that. So
very
fortunately,
true.
we've got basically no deals in our portfolio that have shorter term debt profiling. So if anyone's looking to do commercial real estate deals or anything of that nature, you could probably get away with doing a bridge loan right now today in the market because obviously we know things are churning through. The discounts are kind of happening right now. You put a shorter term debt note and it's a riskier profile, but you could likely, make it make sense. Floating rate debt, similarly, you could probably put a floating rate debt deal on a deal right now and float the rates as they go down, as opposed to if you had floating rate debt before, you were here and then the evaluation goes up there. Next thing you know, you have a delta and you can't make your monthly payments, or you got negative cash flow or an alligator property where you're feeding it. So fortunately, we're in a situation right now where our portfolio is incredibly stabilized. And I think this is a great lesson where we actually did have a lot of deals of ours that were not in that profile. But fortunately, we had a unique program that we were able to take advantage of that, increased the property's NOI value because we limited the property taxes. And then we additionally put in really great long-term debt, 5, 7 year, 10 years on some of these deals to make it more stable for the long term. So although, we didn't buy every single deal perfectly in the cycle or the right structure, we're fortunate that we're not going to lose any investors' dollars, which is the most important thing. And then now we can also most happily play offense where a lot of people are playing defense, where we can buy deals, where we can raise new equity on our opportunities as opposed to a lot of people who are raising money to meet their capital calls, not expand their portfolio. So a lot of people are contracting and we're extracting right now. We're growing at the moment.
Um, how would you advise an LP looking to invest in multifamily to make sure they're investing in the right operator when they're
That's
looking to invest?
That's a great question. So it comes down to a couple of things. Number one is the operator. So we're the operator, we're the sponsor, we're the general partner, the lead sole operator sponsor. So you want to look at, their track record. So first off, track record, see how many deals they have in their portfolio, see how many exits they've had. And then, there could be a lot of people that may have done really well. They took a riskier plan. And you got to also ask the next most important question is what's going on in your portfolio today? Because maybe they haven't made a capital call yet, but they've got 6 to 7 they've got to make it coming up in their entire portfolio where they're kind of skewing or hiding the numbers or massaging it for their benefit, and maybe there's so much turbulence in their entire portfolio that they can't really manage the new investment very well today because their head's somewhere else, which is very understandable. So check out what the structure of the deal is, audit their underwriting, make sure that their assumptions and their inputs are, reasonable. Is there a value add play? Well, is there loss to lease? Meaning, is there, a lot of delta in what rental income is on their property as opposed to what market rent is? Is there a value add enhancement plan to get to the certain numbers that they're projecting? And then the most important thing right now is just making sure that you are putting the right debt and equity profile on a deal and you're buying well, because you can still, even though the market's churning through deals right now and a lot is coming up and we have to think that we're close to hitting the bottom from a market perspective, we're just covering that right now. You can still lose money in this market. And also, I think the biggest thing is, really just do make sure that the rent assumptions and projections are reasonable, because if someone's projecting 5 to 10% rent growth, that's really probably not going to be realistic if we're in the middle of a recession. So, I think the name of the game is to invest in more conservative in nature deals right now. You're never going to catch the bottom perfectly, but try to figure out a way to create a really solid tax advantage returns in that regard. And, just figure out, what the trust level is of the sponsor is, make sure that you do develop a relationship with them to a certain extent where you can feel comfortable to work with them and to put your hard-earned equity with them on their newest opportunity.
No, I think one of the things I really want to point out too is their acquisition debt. That is huge, huge, huge. Even for what I do, it's one of those things where like if you got really good debt, it makes or breaks every deal.
We are in the debt business, believe it or not, right?
Yeah,
And if we were buying everything cash, then we'd probably be only looking to solve for what the cash on cash return is, what the
yeah,
profile is there. But when you're in the debt business, you're taking, risks. So the deal's risk is directly associated with the debt profile attached to the deal. So understand what that is, learn what that is, and figure out what the best profile for that said deal may or may not be. And also, it's got to be in alignment. You, as an investor, one who is listening to this show, might think to themselves, okay, well, you know what? I'm super conservative with all my other investments. I'm, an S&P 500 person. I'm, putting my money in stocks and bonds. And due to the safe nature of that profile, maybe you want to get super uber aggressive on your, commercial investments to get outsized returns. So that might be fine. That might be actually in your investment thesis, but just realize what you are taking on and accruing, and what's associated with you as an investor in a specific deal.
no, 100%, 100%. I love it. I love it. I'm in the land space and I have to deal with that all the time too. So it's one of those. It's a big buying power that if you can get the right debt, you can really get creative and buy whatever you want. So let's talk about capital raising. $400 million, and I think you said you're looking to buy another 200 million. What's the best place to find and source capital to your niche?
Yeah, that's a great question. So, capital raising, and this is just a general PSA to anyone who's doing it or in the space, the best time to raise capital is not when you need it. You dig the
Ooh.
well before you're thirsty, not when you're, parched and dehydrated in the middle of the desert. So, the best way I think to do it, if you have no bearing, starting from ground zero, is to join groups, to join masterminds, and to go to conferences. I think going to conferences, especially now that COVID is over, could not be a better place to go and a place to start and a place to be in. Going to conferences where you're meeting people like myself, like my business partner Rob, the principal and founder of the firm, and various other people who are, raising equity for deals. That's where you want to be, where you can meet a lot of people. So if you're looking to raise money for the lead sponsor, you're going to meet a lot of people who are kind of boutique capital raising people who can bring somewhere between, a couple $100,000 to a couple $1 million per deal. You can meet them there. Some conferences are more LP focused. You just want to fish where the fish are. So, and then I'd also say, it starts always first with your friends and family network, but go to meetups, go to groups. This is where people are looking to meet, looking to look where you're doing. Like, think about this. Imagine if you could go to a place where you do something and then you've got other people that are ancillary to your job. Well, what a great place to actually go and invest the time to be there, right? So I would recommend, meetups, masterminds, and then of course the best is not the cheapest, but the best is go to conferences.
Are you guys, what type of fundraising structure are you as far as like syndication or the fund model on the back
Yeah,
end?
so we syndicate deals. So in that there's several ways you can skin a cat with regards to capital raising and kind of the world that we play in, which is for ticket size, multiple $1 million, deals. The way we like to do it is there's a co-GP route, which is becoming less and less known. It's a co-general partner. They basically raise a couple $1 million for your deals. They have some responsibilities that check the SEC requirements associated with being a co-GP. And then there's the fund of fund structure, which is now becoming very, very popular. And what the fund of fund structure essentially is creating this is going to sound a little bit complex, so I don't know if the audience will fully get this, but there's basically a double waterfall structure in there where, we basically look to solve for the fund manager to come in and let's say if they raise $1 million, we want them to make somewhere between 10 to 14% of the money raised there per the deal. So if you raise $1 million on a deal, we're looking to have that fund manager make somewhere between $100 to $140,000 over the five year process long cycle hold period, right? So, effectively, there's a fund to fund model there that we are really utilizing a lot more. And what you do is create an SPV, which is a special placement vehicle. We've partnered with a group called TribeVest, who's a back office partner with us. But anyone who's looking to create an SPV or a fund to fund can work with anyone they want. They're just someone we find to be very cost effective, as creating a fund, as I'm sure you know, Daniel, is not the cheapest endeavor. It can be very, very effective or cost effective and create what's known as a big drag, which are recurring costs and upfront costs associated with the deal. So we like to try to mitigate that as best as possible and at least provide a lot of our partners with options there. So there's, the co-GP and the fund and fund model. There's the LP investor, which is a limited partner where you're very passive in the deal. And then there's a couple other structures, but the final one I'll mention is a joint venture equity group partner. So you could, or actually two notes. So there's a joint venture equity group who, may come together as a, institutional investor, like a BlackRock, think of something like that. Blackstone, they'll come in and they'll write a check somewhere between $5 to maybe even $50 million on the right opportunity. If it's a big portfolio, they'll come in and write that deal there. And you're basically, running the property as the GP, the lead sponsor. You're managing the asset and whatnot, and they're coming in and helping with some decision rights. But the good thing about working with a group like that is they also are incredibly sophisticated and savvy and have got analysts crunching numbers and stuff. So they provide some guidance and help along the way there. And then the final one, forgot to mention this, but is 1031 exchanges. So one could come in through our structure via the tenancy and common tick structure for 1031 exchanges.
No, I'm really glad you mentioned the 1031s because a lot of people, I think, don't know about that, about getting 1031 capital. Because I think there's a lot of 1031 capital out there, but nobody knows how to utilize it, and they're always looking for a place to go that provides a safe IRR.
Yeah, a safe IRR and ROI without a doubt. And to your point, the recapture costs is so great for some of these people when you factor in the incredible and lucrative accretive tax advantages associated with investing in real estate. If you're depreciating property and whatnot, and you're kind of, at the fifth hour or the 11th hour or whatever you call it, needing to place that equity into a deal, it's really, really challenging to have a good opportunity. But we do provide an option and a shelter for one to come into our opportunities. Of course, we need to know early enough on in the process to make sure that our lender can underwrite them and go through the process, and that the debt and equity is sized up and matched accordingly. But 1031 exchanges is something that's not 100% universal across the board, that people do allow into their capital stacks and structures when we do buy deals, but that is something that we certainly do accommodate. And our biggest investor we've actually ever landed is a massive family office out of Long Island who has given us ample dollars via the 1031 exchange route. And in the event that they didn't or we didn't have that opportunity there and we weren't compliant to that structure, we probably wouldn't have earned or landed their business. So it really does give us a nice, competitive angle that not everyone does in fact have.
And I don't know this, and this is what I'm asking. Do they still have that 1031 structure after they exit as well? Whenever they exit out of your investment, because this is new.
Yeah, that's a really great question, and I'm happy you asked. So essentially the way it works is if you're an LP, so I'll break this down twofold. If you are an LP investor, like you want to come in, you see one of our deals, you're excited, you want to make, let's say a $50,000 to $100,000 investment as a first-time investor, incredible. The way that would theoretically work is you would come into the deal, you basically be buying a security as opposed to directly into the real estate, but it's effectively structures and works as the same thing, right? So you have the option at full cycle of the deal. If the deal does in fact do well, you can 1031 exchange deal to deal. So from deal A Lone Star to deal B Lone Star, but you can't go deal A with Lone Star to a different deal 1031 exchanging that into a different syndicator's deal or your own deal. So you could either cash out or roll the deal in the equity if there's a gain to our next opportunity. If you come through as a tenancy in common TIC investor, let's say you have your own deal, you're tired of managing it, you're a landlord who's just over the process of having to collect rents, deal with everything, you want to sit on the beach, sip your Mai Tai, and not worry about anything other than what am I eating for dinner and what color is my rental car, right? Great, not a problem. You can go from your deal into a Lone Star Capital deal, be there. Next thing you know, you've had a nice IRR, a nice ROI on the investment. Now at that point, you have or multiple options. You can obviously cash out, which is probably not what you want to do because you want to keep the money rolling and keep cash and cash going. You can 1031 exchange, so that's option A. Option B is go 1031 exchange from a Lone Star deal, so outside of a Lone Star deal into a Lone Star deal into a new Lone Star deal. Or option 3 is you could 1031 exchange out of our deal into one of our next deal, or as I just mentioned, or into a different syndicator's deal, or to your own deal at that point if your exchanger can accommodate the debt and equity structure. So there's 3 routes you have when you're going in as a current TIC investor to the next part. You can sell it, trade into our next deal, or trade into someone else's deal.
How are you managing the debt side of it? Because usually that has to be attached to or carried with in equal or greater value to the next properties. How are you allocating the debt side? Is that they become the lender on that property essentially and they get paid off ROI, or how does that work?
Yeah, so effectively to your point there, what we try to do is be early enough in the process to make sure that the debt and equity is set up, but also to your point, that the lender underwrites them because sometimes they are signers on the property. So the lender, we need to be in there early enough. It can't be like, hey, we're closing a property, let's say next week. Hey, guess what? We've got $5 million or $1 million or $500,000 we want to exchange. Do you have room? The answer is no, not for you as a 1031 exchange investor because our lender and our processes have to line up. So typically speaking, we have consultation calls throughout the entire process with people who are just thinking about selling today or know there's going to be a maturity coming up in a year that they want to exit out of. They want to kind of spar with us to make sure there's a philosophical alignment and a meeting of the minds to make sure that they think that they're a good fit for our next opportunity, if that makes sense. So essentially, it varies through the process. Sometimes we get deals that are sprung upon us, and then sometimes there are people that talk with us well in advance that are queuing up an opportunity to make sure that we are able to be in receipt of their equity when the maturity and timetable comes up.
Yeah, man, managing the debt side of the 1031 makes it cumbersome in some cases. So I think communication is paramount.
You are so spot on there. You really are hit the hammer on the nail there. Like you cannot be more accurate. There's so much that goes on to this process. It's really not as easy as one would think, unfortunately, and rightfully so. This is millions of dollars that we're talking about here from time to time. This is delayed and deferred taxes for sometimes multiple decades going on. So there's a lot to account for. And it's very stressful and hairy for a lot of these 1031 people. I do not envy their situation when these opportunities come up because it can be scary. It's a tumultuous process. It's, nerve wracking, and, what was really crazy is actually this is kind of an interesting story in 2020 when debt started to kind of go up, when rates started to actually increase, as we remember, right? Roughly around May or so, a lot of bridge lenders were getting out of deals and were backing out and whatnot. We had an investor that was looking, this big person from Long Island, as I was alluding to. Our lender, a week before closing, said, "Hey, sorry, we're not going to do the deal anymore." And like, whoa, well, the recapture in that process had that knock on through would be really, really detrimental. They would have what's called phantom income. And for
Yeah.
those who don't know what phantom income is, that's when you have a tax liability that's from years ago that all of a sudden pops up now. So, and for some of these people, that could be the tune of, oh, wait, I have to pay what now? So the value of real estate, there's many of them. And I think, real estate as an asset class is so superior when you factor in the ability to trade in, trade out, trade in, trade out, and improve, because you can't 1031 exchange Apple stock into Google stock, but you can 1031 exchange a property from, let's say, I don't know, Seattle, Washington into Dallas, Texas to, Manhattan to XYZ. So you can kind of play with those, you can maneuver so much better and so much differently in the real estate world as opposed to the traditional stock and bond world.
Ooh, that's a mouthful. No, it's good. What's the target IRR that you're giving to your investors? Because mentioned earlier that somebody had like $1 million allocation, they're trying to get 12 to 15% on their capital at over a 5 year span. Is that annualized across all 5 years, or is that across annually 140,000 per annum?
Yeah, it's a really great question. So typically what we look to solve for is something with, a 14 to 19% return on projected numbers. So of course it's just projections. We
Yeah.
don't know exactly what that looks like or
No
not. So
guarantees. No guarantees.
the G word does not exist in my repertoire or the real estate business. I don't even want to even say the G word. I call it the G word for a reason because it doesn't exist to me. Okay, that's the only swear word that I don't use. But with that said, we typically like to shoot for something between a 4 to a 9% cash on cash return over the hold period, and then a lift at the back end. So somewhere between a total return of 14 to 20% over that hold period. So we've done 2 deals that have gone full cycle with the average IRR of 30%. I would like to say that we're like Jesus and we walk on water, but we, like many other sponsors, got fortunate that COVID had some very fortunate tailwinds for the business with rates getting crazy. We had 2 exits there, but right now we're raising on deals that are somewhere between, a 16 to 18% with the current market in distress.
I don't think I asked this, but I didn't ask what type of asset class. We've been talking about capital and capital structure for the last
Yeah.
20
We
minutes.
do, multifamily acquisition. So multifamily housing, what we like to buy is, workforce housing, which is deemed renter by necessity. So many people forget that, most people in this country don't live in beautiful big houses like what Instagram or MTV Cribs would show you. Most people live in a world where, we're in apartment complexes and, are working multiple jobs right now. So we cater to that. And a lot of tenants are wanting, upgraded stuff. And the biggest thing you have to think about is, you can't remake or replace, economically speaking. We can't do that at a clip that is affordable or economically viable. So we're in this space where it's not able to replace, but there's a nice value there because there's a discrepancy between rents are, what the units look like, and for us to come in, maybe spend $8,000 per unit to get a $200, $300 rent bump is obviously very accretive on top of organic rent growth. So that's how value is created in our space. And one of the big tickets and items we look for is the word replacement cost. So if you're buying newer assets, how much lower is this to replace it? Now, depending upon where you're at, it might cost $200,000 to build new inventory. So
What type of like size units are you buying as far, and are they B and C class? That was my first question. Are they B and C class type units, and what type of like max structure? Because I think people at your level are probably looking for like 50 units and up. You're not looking at anything under that.
we're looking at really, really actually bigger units than that. Our minimum mandate now is about 150 units for it
Yeah.
to make sense for us, and we're looking kind of in a various range with regards to assets. We're pretty, as what we call it in the space, opportunistic,
Yeah.
meaning we're looking just for the best return profile possible. So that's kind of how we view and see the world. It's looking for that there, looking for A, B, and C wherever the value lies. Typically speaking, we look to buy, I would say, probably closer to that B range, but ironically enough, we're looking to buy a deal right now that's an A probably property in Houston,
Yep.
and then we're actually just closed on a deal that was a C property in San Antonio. So, a pretty big spectrum. And we're talking about a $700 rent delta between the San Antonio property that we just bought, as well as the Houston property that we're acquiring right now. So it's definitely a pretty big range there, but we feel comfortable. We've taken on, nicer deals and some deals that need a little more love and TLC and cleaning up with the tenant profile, depending upon if there's, frankly, sometimes gangs associated with being there. So you just never know.
What's what's your number one go-to to create a higher NOI?
Well, right now, with tenants being stretched and maxed out right now, what we're not really trying to do as much is, pushing up rents a bunch, or maybe the value add play doesn't make sense with where we're at right now.
Yeah.
But one thing that we're doing right now, which is super interesting, unique, is a bulk Wi-Fi program. So effectively, we're wholesaling back Wi-Fi to tenants. Think about this: every tenant probably has Wi-Fi or needs Wi-Fi for the most part. I would say, 95% of the time, a tenant needs Wi-Fi, right? So what is really nice about this is we're able to charge, a discounted Wi-Fi rate if one like you or me were gonna apply for an apartment. We can give you a competitive advantage on the Wi-Fi pricing. Then we can also make about $35 per unit on that as well. So things like that are giving a nice little pop. So think about this: if you're buying a 300 unit property, and you're doing bulk Wi-Fi now, and you're creating $35 of income a month. Well, let's just do some quick math there, right? That's 30x 300.
It's $900, $9,000 a month. If
Exactly.
you have an 8 cap rate, it's like 720 grand.
It's not a nominal amount of money and value that you're adding to the property. So that's a small little ancillary item. But the biggest play and way we're actually making big NOI pops is doing what's known as a tax abatement deal. So in Texas, there's obviously crazy rent growth and migration here, and unfortunately, there's a lot of affordability issues and crisis. That's not just subject to Texas, but what we like to do is tax abatement deals where we eliminate either partially or all the taxes associated to the property. So naturally, in a state like Texas with no income tax, as we all know, they're going to get you one way or another, right?
Yeah.
Same as Florida. It's property taxes, sales tax, things of that nature, right? So when you go and buy a deal in Texas, that's a very big variable that's going on. So we look to eliminate them if possible entirely. So we've been able to navigate that. We've got about 11 deals in our portfolio now that are utilizing some form of tax abatement profile. That's very attractive and compelling. That doesn't really change, the upside of the deal, but it certainly affects the downside and gives us a very nice competitive advantage where we're kind of coasting into a really nice premium return while not accruing that much risk after kind of getting the property closed and the structure in place.
How are you instituting the tax abatement? Is that through an attorney, or what's the process for that? I've never
Yeah,
heard
we've
of this
got
before.
Yeah, we've got several attorneys as well as advisors that we work with directly that are, utilizing that program, that have relationships with the housing authorities, whether it be the SAHA, which is San Antonio Housing Authority,
Okay.
the Dallas, Housing Authority, or the HHA, the Houston Housing Authority. So those are the kind of angles that we're looking to navigate and play in to give us, a competitive advantage and a unique kind of profile.
No, it's definitely. I've never heard of that one. It's very unique. Very, very unique. I'm taking notes right now.
Yeah, absolutely. And if you want any information on that, I'd be more than happy to send you some of the flavor that we're looking at.
For everybody here, that's the power of podcasting.
It is.
You learn new lessons, and you make new connections, and you never know what you're going to learn.
Yeah.
I'm gonna ask some good questions this time. This is good. I'm sure this is not your regular podcast for sure.
Well, I'm happy that I got to educate and kind of, I guess, give a new twist and hopefully open the minds of some people with kind of some unique angles. And it's kind of interesting as a lot of people invest in Texas to not be in rent controlled properties, believe it or
Exactly.
not. But these deals are in fact rent controlled to a certain extent on about half the units, typically speaking. But when at the end of the day, all these investments are Excel spreadsheets, which lies math. And when you factor in the math associated with this opportunity, it's very creative and beneficial for those who are looking to solve for bigger than stock market like returns while also receiving tax benefits and also advantages with regards to just investing in general with real estate.
So I want to ask a question about your internet packaging. I've seen recently, what is this? it was a cable TV packaging, cable TV internet packaging. Is that a new phenomenon? I've only seen it recently in one other transaction, but I don't know how new this is because I haven't seen it. And like I've been in real estate for a couple of years, and I have not seen
Yeah.
anything like this before.
Yeah, no, we're really unveiling this throughout the entire portfolio right now. So for us as well, it is also kind of a newer advantage that we're taking in, that we're kind of entering, and it really starts to make sense, with economies of scale, and that's kind of the benefits of multifamily real estate is that economies of scale benefit with management and such, and the cash flow there. It's tough to manage just one door at a time. If you're a single family owner and operator, it's where most of us
Absolutely.
start. Obviously, I used to sell homes, so I know the pain points of all that. I was a realtor for about 7, 8 years prior to getting into this world. But interestingly enough, it is a newer program and profile that at least we're doing. And I do think it'll be more common practice throughout the program. So hopefully, not every competitor of ours sees this, so they don't implement these strategies, but you never know. And eventually, it'll be kind of standard practice for the sophisticated folks who are coming in and kind of doing their homework.
No, I think I see a wave coming, and like I said, I seen it recently, like probably a month ago, and then you mentioned it here, and I'm like, okay, if
It's the trigger words.
it's the if people are figuring it out, the information is getting out there, and the utility companies, not necessarily like the water, electric, but the electronic services, whether it's TV, cable, and internet, they're now reaching out, probably packaging because to them they can do bulk pricing.
Yeah.
It makes sense for them too. So it's definitely a unique strategy for everybody out there. So you never know. Go ask
Yeah.
around. I think this has been an amazing episode. I think, like I said, I this has been very interesting to me because, like I said, I'm not in this space. So I'm always intrigued whenever somebody comes on. Then we can talk commercial because I don't get the opportunity very often. I'm a land guy at heart, so I don't get the opportunity to talk commercial very often. But I hope
Yeah.
I,
Well, I'm
I
happy.
hope I ask good questions.
You asked very good questions and you kept a very good cadence and flow, which doesn't surprise me at all, of course, but it was a very fun conversation. I'm happy that I could provide you some value because obviously, the more you know, the more conversations that you have, in fact, you're going to get, different frames of points and references. So it's always so great to add to the network. And that is the beauty of podcasting. And the other beauty of podcasting is how accessible people are in the space, right? I can't tell you how many people that I've had reach out to me or that I've had conversations with because of the podcast forum. We're just normal people. Reach out to us if you have any questions about the space. We're here to help and here to serve you, and be a good custodian of your equity. We all work so hard to make money and then also so hard to save it. And then we want our money to work harder for us so we can get that return. We can get some of our time back. We can enjoy our life. So to be able to provide that and hopefully a unique angle into that is something I'm super passionate about and want to enrich everyone's life with as much as possible if given the opportunity.
One thing I think you're probably doing, and I don't know if it's 100% true, but if a new LP comes into your structure and wants to learn about multifamily and why you invest the way you do you provide some type of front end education to kind of educate them in the space? Because I think it's very paramount for LP investors to know what they're doing and know what they're investing in. That way, even if they don't invest in your structure, your fund or fund of funds or syndication, they at least can tell and learn how to do this, at least from the LP side.
Yeah, we've got hundreds of hours of YouTube information, whether it be Rob, who legitimately wrote the book on underwriting, the principal and founder of the company, Rob Beardsley. We've
Awesome.
got books out there. We've got YouTube information galore. And then when we do talk to people, I like to ask qualifying questions such as, what's your experience level? What's your background? So on and so forth. And then really explain to them, find out what their needs are and what their wants are and, what we can solve for them. Because at the end of the day, the last thing we want to do is just take money to take money. We got to make sure that it's a good fit where they like us, of course. It starts with that, and then we like the LP investor, and that it's a good fit there. And then you actually know what you're putting into your body if you're on a diet or something like that. You got to know what's the ingredients you're eating. Similarly, well, if you're making an investment, what makes up that investment? So we certainly do help people understand what's going on and kind of the associations regarding the deal, how we arrive at to the conclusion of the projected numbers and things of that nature. Certainly, and it's all about asking, like you've done here on the show, good questions, qualifying questions, things of that nature to make sure that everyone understands what's going on.
Not all money is good money.
That's true, and not every client's a good client, unfortunately.
Absolutely. Where can people find you online? We're going to end it here. I think it's been a great episode, so I appreciate you coming on and sharing some
Yeah,
information.
no, I really appreciate you giving me an opportunity to speak to your people and be on your platform here. It's always an honor to just talk real estate. I'm obviously very passionate about it, but if you want to find me, I'm on YouTube. We're on, Craig McGrouther is my YouTube channel, and then also Rob Beardsley and myself. we've got the Lone Star Capital YouTube channel there where you can find all of our information. And then, of course, I'm all over LinkedIn. So just my first and last name on LinkedIn. Feel free to go there. We've got our clips and things of that nature. So we're very accessible. And then, of course, finally, my email is craig@lscre.com. So just my first name at lscre.com. The acronym is Lone Star Capital.
There you go. For everybody here, go like, share, subscribe. We'll see you in the next episode. Thanks for tuning in, guys. Thanks, Craig. Bye, guys.
Thank you.